In this video, I'm going to talk about the iconic FTSE 100 and why I will not touch it, and instead where I personally believe you should invest. The purpose of this video is to help you understand your investments, and if you're invested in the FTSE 100, it's better to have an understanding of this so you know when to keep buying more or sell. Therefore, no doubt this video will be controversial, as I imagine a lot of you watching this video are in fact invested in the FTSE 100. However, I encourage you to have a discussion with me in the comment section down below, and if you disagree with my opinion, simply click the dislike button. Before talking about the serious issues with the FTSE 100, I'm going to break it down for beginners. The FTSE 100 is the 100 largest companies listed on the London Stock Exchange by market capitalisation. Basically, the bigger the size of the business, the higher they rank. However, there is a common misconception that all of these businesses are UK domestically based, and I understand why you may think that, but it's simply not the case. In fact, the revenue from these companies, 70% of it comes from overseas in total in the FTSE 100. Therefore, it does not accurately represent the state of the UK economy, but rather reflects a general global economy. Also, don't forget that the stock market is not the economy. Yes, they may correlate from time to time, but there are also times in which they will not correlate. Although you will see that the UK has not done too well for the last few decades, and a way you could check this is by looking at the GDP. Anyway, this has led to the FTSE 100 index trading sideways for 22 years. And in fact, if you'd have invested on the 17th of April 1998, you would have had capital gains of 0.35%. You would have gotten more in a low interest rate bank account. However, that doesn't really do it justification, as this is something that you would invest in for the dividend income. And so when investing with the dividend income, your returns would be higher, but still not greater than other markets. This is also biased because it is assuming that you had invested a lump sum 22 years ago and then forgot about it, whereas a lot of you watching this video most likely already cost average into the market and consistently every month or even every week put money in. Regardless, because it has traded sideways for so long, you could argue that this could be an excellent opportunity to invest, but I'm a long-term UK investor, and so what we need to do is look at where we think this will be in the next 10, 20 or even 30 years. If you're interested in getting 2 free shares worth up to £100 each, go into the description down below and click the link. Right, so what are the risks of investing into the FTSE 100? And why will I not touch it? By far, the biggest risk with the FTSE 100 is their diversification or lack thereof. This can unfortunately be broken down into 3 main stages. Firstly, there is a huge imbalance between the biggest companies and the smallest companies in terms of weighting or allocation to the FTSE 100 fund. This means that the biggest stock listed in the FTSE 100 currently has a weighting of 7.04%, and that's AstraZeneca. Also, the top 5 companies make up over 25% of the FTSE 100. Furthermore, this is fueled by many of the companies taking up high allocations, meaning the more quality stocks will take a lower allocation. An example being Shell, that takes up 6.25%, and comparing that to London Stock Exchange, which takes up only 1.38%. Therefore, a majority of the returns that will be generated in the FTSE 100 will be tied to these large companies. And that may not necessarily be a bad thing, but I'm going to explain why these companies aren't the best to have it tied to. These companies are usually dinosaur companies with little to no growth potential. Whilst yes, they do make loads of money, have high profit margins, and can return that as dividends to shareholders, they simply have little to no growth potential. With the exceptions of AstraZeneca and GlaxoSmithKline, which are in the healthcare sector, a majority of these stocks are in fact actually in so-called dying industries. And this is confirmed by many people that honestly believe this. An example of this would be tobacco, oil and gas, and particularly the UK banks, which are struggling at the moment. Maybe not dying, but certainly struggling. Oil and gas are under a lot of pressure to revamp or change their business models. This is because there has been an increase in the trend of renewability. And whilst yes, this may take 20, 30, 40 years, we still need to look at the long term. And during this period, there's a lot of uncertainty and risk in these stocks. This means that yes, whilst at the end of this, they could become absolute gems of companies, is it really worth investing into them whilst they're still trying to figure it out? I personally prefer a secure, repeatable business model that can organically grow and don't like the risk that they are taking on. However, if you're more interested in why I don't like BP or Shell, click the card at the top right of the video. The outlook for tobacco isn't too great either. As a society, we are becoming a lot more health conscious, and this isn't even the main reason. What I see a lot of is that the taxes for tobacco keep increasing, and I think this is due to the whole health problems around it, effectively meaning that these cigarette companies or tobacco companies have to charge higher for their products to maintain their profit margins. But this also means that eventually there's going to be a point where they'll keep increasing the price, and at what point do the customers think, you know what, actually I no longer want to buy these products? If they do decide this, they are trying to transition into more of the vapes and vapor products. However, whether this is better for your health is still uncertain. Therefore, these companies have historically dragged down the performance of the FTSE 100 simply because they have such high weightings. Even the tobacco companies are taking up 5.43% of the index. Another issue is that because their exposure to certain sectors are so low, they are missing out on a lot of potential growth. You'll notice that in the S&P 500, they had a lot of success and they're performing quite well, not only because the Fed is pumping their market, but also because they have technology stocks. The FTSE 100 has a very low allocation to technology stocks, which means there's a lot less growth potential. Technology stocks have recently shown how resilient they are and in fact gone to prove that they can continue growing in the midst of a pandemic, simply because of how easy it is for them to transition their business models and have their employees working from home. But the FTSE 100 falls behind simply because it only has a 1.37% to the technology sector. Furthermore, the sectors I personally believe that have growth potential going forward are healthcare, which the FTSE 100 does have 13% of, technology and consumer discretionary, albeit the last one a bit cyclical. And in total, this only takes up 21.59% of the whole FTSE 100. I personally don't see much growth potential in there, and I'm a dividend investor. Whilst yes, I like these companies that pay high dividends, I like them to grow it also. These giants in the FTSE 100 lack dividend growth. If they do it, it's at a very slow pace. Look at Shell. For 4 or 5 years, they'd stopped growing their dividend and then had cut it during the pandemic. Understandably so. Same applies to BP, although they did try growing it somewhat. Look at GSK or AstraZeneca. They've not grown their dividend in the last 5-6 years. These are all such giants listed on the FTSE 100. They're providing high yields, yet no capital gains, except for AstraZeneca. Going forward, I would only consider investing into the FTSE 100 if it was for these two crucial factors. Firstly, if you're nearing retirement or at the stage of retirement and you need reliable, safer dividend income, then the FTSE 100 may be for you. It's currently yielding 3.7% according to dividend data, and this could be a sustainable amount to keep drawing away and living in retirement. However, if you're not nearing the age of retirement, then there's really no need for you to be invested in the FTSE 100. However, there is some way you can compromise. If you like some of the companies here, but obviously the good quality growth stocks have a much lower allocation, you can get an equally distributed allocation FTSE 100 fund, which may be a better alternative, albeit at a lower dividend yield. However, if you strongly believe that the UK economy is going to go into a downward spiral and crash, destruction everywhere, fear, and you believe it's really not going to go well, then the FTSE 100 may be a good hedge for you. This is because you can invest in this using pounds, so there's no currency risk when investing in S&P, even though you could get a hedged fund. But it also means that if the pound drops in value, that this asset actually rises in value. And since they have only 30% of their revenue in the UK, it effectively means you're globally diversified in terms of revenue, although poorly with sectors, individual stocks and performance. And honestly, I think if you're at a younger age, there are much better options for your capital to appreciate. So where would I place this money? If you're looking for UK exposure, strong growth potential and a higher than average dividend yield, then I believe the FTSE 250 is for you. This has a better representation of the UK economy, has better distributions in allocations and more diversity. No, there's still not an amazing amount of technology inside of it, but it's certainly a step up from the FTSE 100. If you're bullish on the outcome of Brexit, you believe the pound will rise, then a majority of these companies that are domestically UK based will actually benefit from this. Therefore, they could import goods for a cheaper price. Since they're also, by average, smaller market capitalizations, this means that you can get higher growth potential simply because they are still in a high growth stage, at least more than that than a majority of the FTSE 100 companies, This effectively makes the FTSE 250 fairly future-proof. This is because as stocks become too small and perhaps unprofitable, they will drop out the FTSE 250, but also as they become bigger and maybe with less growth potential, they will go into the FTSE 100. And this allows for a fairly balanced fund. However, there's always another option. If you're not interested in the UK economy, then I would personally suggest investing in a developed world ex-UK, which basically means you're investing in all of the developed world's economies except the UK's. And if you're not very bullish on the outcome and you want to minimize your risk of Brexit, then this could be a very solid option for you. If you're a stock picker like myself, there are certainly some hidden gems that you can find in the FTSE 100. So it will require sifting through these not so great quality companies, but if you have the patience and you do your own research, then you can certainly find some hidden gems. I will personally have it so that my investments in my ISA are UK equities that I believe will outperform the market. Then in my SIP or pension plan, the idea is to have a developed world ex-UK fund at a 90% allocation with a 10% allocation into the emerging markets fund. This gives me global diversification on all of my investments, but also gives me an opportunity to stock pick in an understanding of a market I already live in. Once again, if you're interested in why you shouldn't buy BP or Shell, click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.